All businesses go through several stages in their corporate life. Damodaran has one framework as shown here. I don't invest in startups and young growth companies, but focus on the high growth, mature growth, and mature stable ones. The intrinsic value of a company is the present value of the cash flows generated by the company over its life. There are two key issues here. What is the cash flow and what is the discount rate to determine the present value? There are three ways to model the growth in the cash flows. The single stage model is generally applicable to companies in the mature, stable stage. The two-stage model divides the company growth rates into two distinct stages. And the multi-growth model is one where the high growth rate changes over time to the lower growth rate. Once you have the cash flow, you have to determine the present value of each of them. The value of the cash received in future is smaller from that received today. This time value of money is due not just to inflation, but also to account for opportunity cost and risk. As I'm looking at cash flows to the firm, the discount rate is the weighted average cost of capital, or WACC. This takes into account the cost of equity as well as the cost of debt. You can determine them from first principles based on theories such as the capital asset pricing model. In many cases, I take the average of the rates available online. I follow three valuation gurus: Damodaran, where I discount the free cash flow to the firm; Penman, where I discount the residual income; and Greenwald, who actually estimates the overall return taking into account the discount rate. Companies have both operating assets and non-operating ones. Operating assets are those used to generate earnings such as plant and machinery. Examples of non-operating assets are cash. The various models value the operating assets. As such, you have to add the value of the non-operating assets to get the total value. The first step is to determine that this is a growth company. You next identify the cash flow pattern and select the appropriate valuation model. All valuations are based on assumptions ranging from the model used to the cash flow patterns and the discount rate. As such, I use several valuation approaches to triangulate the value. More importantly, I look for a margin of safety. For more details on how to value growth companies, refer to the article. Thank you.